on PAL Express.
Welcome to today's discussion on trading essentials, where we dig into the important elements that shape success in the dynamic world of trading. In the upcoming study, we'll discuss the complexities of time frame analysis, determine optimal directions for buying or selling, explore effective risk management techniques, dig into the strategic use of stop loss and take profit orders, and shed light on the importance of a robust backtest strategy. By the end, you'll be equipped with valuable insights to make informed decisions and safeguard against potential losses in your trading journey. Time frame analysis. A time frame refers to a specific period or duration during which events occur or activities take place. It is a way of expressing the time span between 2 points or events. Time frames can vary in length, ranging from very short durations, such as seconds or minutes, to longer ones, such as hours, days, weeks, months, years, or even more extended periods like decades or centuries. So, time frame analysis in trading charting tools involves studying price data across different time intervals to gain insights into market trends. Traders use this approach to identify patterns, make informed decisions, adapt their strategies based on the specific time horizon, and enhancing their ability to navigate the dynamic cryptocurrency market. For example, Natural Vision Optical, a clinic, often use time series analysis to understand how their sales trends change over time. By analyzing monthly, seasonal, and yearly sales data, they can predict future sales patterns. This allows them to plan inventory and staffing levels accordingly. For instance, if a store observes an increase in sales every December, they can prepare by stocking more products and scheduling extra staff during that month. This type of analysis helps businesses make informed decisions based on historical data and observed trends, optimizing their operations and improving their chances of success. There are 3 different time frames: smaller time frame, longer time frame, and multiple time frame. A smaller time frame, or the lower time frame, typically refers to shorter time intervals for analyzing price movements, such as minutes or hours. This rapid analysis is useful for day trading or making quick decisions in response to immediate market changes. This is suitable for active traders who can closely monitor throughout the day. Also, this is used for scalping in crypto trading. Scalping is a trading strategy characterized by making numerous small and quick trades to exploit very short-term price movements. Traders who engage in scalping, known as scalpers, aim to scalp or capture small price differentials. This strategy relies on the idea that even small price movements can create opportunities for profit when traded in large volumes. Imagine you're an investor interested in purchasing shares of a technology company on PAL Express IT Solutions. You want to conduct a time frame analysis to make an informed decision about whether to invest in the company's stock. You conduct a short-term analysis using daily charts to fine-tune your entry and exit points. On the daily chart, you observe that the stock recently broke out of a consolidation pattern and is trading near its all-time high. However, there is a short-term resistance level at $150 that the stock has struggled to break through in the past week. And you decide to wait for a clear breakout above $150 before initiating a long position, as this could indicate further upside potential. The next type of time frame is the longer time frame. A longer time frame in crypto trading refers to extended periods, such as days, weeks, or months, used for analyzing broader market trends. This approach is often associated with investors looking for sustained market movements rather than short-term changes, providing a more comprehensive view of the overall market direction. Longer time frames are favored in swing trading and crypto, as they allow traders to capture and ride medium or long-term market trends. This approach involves holding positions for days, weeks, or even months to capitalize on more substantial price movements. By analyzing longer time frames, swing traders aim to identify and exploit trends that persist over a more extended period, seeking to benefit from significant price swings for profitable trading opportunities. Let's go back to conducting a time frame analysis on PAL Express IT Solutions to make an informed decision about whether to invest in the company's stock. This time, you use a longer time frame analysis. You start by analyzing the company's long-term performance over several years. You examine monthly or quarterly charts to identify significant trends and patterns in the stock's price movements. Suppose you notice that over the past 5 years, PAL Express IT Solutions has consistently grown its revenue and earnings. The stock price has also shown a long-term upward trend, with occasional pullbacks during market downturns. Based on this analysis, you conclude that PAL Express IT Solutions has a strong track record of growth and may continue to perform well in the long term. The last but not the least type of time frame is the multiple time frame. Multiple time frame analysis involves simultaneously examining price data across different time intervals. Traders use this approach to gain a comprehensive understanding of market trends and make more informed decisions. By analyzing multiple time frames, such as smaller and longer time frames, traders can identify both immediate market dynamics and broader trends, enhancing their ability to adapt strategies to various market conditions. Let's go back to conducting a time frame analysis PAL Express IT Solutions, and you want to make informed decisions by combining different trading time frames. Here's how you can apply multiple time frame analysis. You start by analyzing the longer-term chart, such as weekly or daily, to understand the overall market direction and trend context. You establish a directional bias based on this higher time frame. Now you switch to a lower time frame, such as 4 hours or 1 hour, to look for specific trading opportunities that align with the higher time frame direction. You use this time frame to time entries and manage positions. Here's another example. In swing trading, you use longer time frame as you notice an uptrend on the weekly chart. You also view the smaller time frame, specifically on the 4-hour chart, and you identify a pullback within that uptrend. So based on the higher time frame trend, you decide to enter a long position during the pullback. Remember, the goal is to enhance the profit profile by trading long-term signals in a short-term time frame. Consistency matters, so pick a time frame combination and stick with it to gain experience. Here are some of the common time combinations: the swing trading, shorter-term swing trading, intraday trading, fast-paced intraday trading, classic day trading, and fast-paced day trading or scalping. Choosing the right time frame for trading is a big deal. Traders have to think about what they like, how they trade, and what they're aiming for. It's not like there's one perfect time frame for everyone. But traders usually think about these basic ideas. Read this carefully, as it may help you in trading, and choose which type of trader will you be. Are you going to use a smaller time frame, or the longer time frame, or the multiple time frame? Choose wisely and take your time in choosing. The choice of time frame depends on your trading goals, risk tolerance, and the amount of time you can dedicate to monitoring the markets. Many traders also use a combination of time frames, employing multiple time frame analysis to make well-rounded decisions. And now, let's talk about the directions. Directions. The term direction in the context of trading refers to the anticipated movement of an asset's price. Traders often use the terms buy and sell to describe the direction they believe the price is likely to move. Buy direction, also called long position, traders anticipate that the price of the assets will rise, and they want to profit from this potential increase. This decision is often based on positive market conditions, technical analysis indicators, or positive fundamental factors. Take note that buying is generally more beneficial over the long term, especially for swing trading or holding positions. Let's say you've been following a company called Pal Express IT Solutions, which has been consistently performing well. The company announces a breakthrough product that has the potential to dominate the market. Analysts predict a significant increase in the company's revenue. Believing in the company's growth potential, you decide to buy shares, expecting the stock price to rise to sell them at a higher price later. Sell direction, also known as short position. In this direction, traders expect that the price of the asset will fall, and they aim to profit from this potential decline. They take a short position by selling. This can involve selling shares they currently own, or in the case of short selling, selling borrowed shares with the intention to buy them back at a lower price. This decision is influenced by negative market conditions, bearish technical signals, or adverse fundamental developments. Remember, selling or shorting the market can be profitable for skilled traders, especially in futures trading, but requires professional skills due to its fast-paced nature and higher leverage. Now, imagine another company named Old Tech Corporation, which has been struggling due to outdated products and declining sales. Recent reports suggest that the company is losing market share and might not recover soon. Fearing a drop in the stock price, and to prevent potential losses, you decide to sell your shares of Old Tech Corporation. The directions buy or sell are key decisions made by traders based on their analysis of market trends, indicators, and other relevant factors. These decisions are often supported by technical analysis, fundamental analysis, or a combination of both. Remember, investing in the stock market involves risks, and it's important to do thorough research or consult with a financial advisor before making any transactions. And now, let's talk about risk. Risk per trade. Risk in trading refers to the potential loss of money on a trade. Every trade involves some level of risk. It's a key component of risk management strategies, helping to ensure that a trader can withstand losses over time without significantly depleting their trading capital. Here's a simple breakdown. Determine your risk tolerance. This is the percentage of your trading account that you're comfortable risking on each trade. A common guideline is the 1 to 2% rule, meaning you risk no more than 1 to 2% of your account on a single trade. Calculate risk per trade. If your account balance is, let's say, $10,000 and you decide to risk 1%, your risk per trade would be $100. Set stop-loss orders. For example, if you buy a stock at $50 and set a stop-loss order at $45, your risk is $5 per share. Risk to reward ratio. This is a measure of the potential reward of a trade compared to its potential risk. A common risk to reward ratio is 1:3, meaning for every dollar risked, you aim for $3 in profit. Here's another example. Imagine you're learning to swim. You wouldn't jump into the deep end of the pool on your first day, right? Similarly, in trading, risk per trade is like deciding how deep you want to go each time you enter the market. Here's a simple way to understand it. Your trading pool. Think of your total money available for trading as a swimming pool. Risk percentage. Decide how much of your pool you're willing to use for each swim or trade. A common approach is to use only a small part, like 1% or 2%. Risk dollar amount. This is the specific amount of money from your pool you'll use for a single swim. If your pool has $1,000 and you use 1%, that's $10 per swim. So, risk per trade helps you manage your swims or trades so that even if you don't swim well a few times or take some losses, you still have plenty of your pool left to keep swimming or trading and improving. In mathematical terms, if you have a trading capital of $1,000 and you decide to risk 1% on each trade, the calculation would be: risk per trade is equal to trading capital, multiplied by risk percentage. Therefore, $1,000 multiplied by 1% is equal to $10. This means for each trade, you're only risking $10. It's like saying, I'll only go as deep as where I can still stand. This way, you stay safe and can keep trading for a long time. So effective risk management is crucial in trading to protect capital and minimize potential losses. This knowledge helps in optimizing the risk per trade for your specific circumstances. And now, let's understand what is stop loss and take profit. Stop loss and take profit. Stop loss and take profit are terms commonly used in trading to manage and control the potential risks and rewards associated with a position. These orders are placed in advance to automatically execute certain actions when a trade reaches specified price levels. A stop-loss order is a risk management tool used to limit potential losses on a trade. Traders set a stop-loss price, which is the level at which they are willing to sell an asset to cut losses. If the market price reaches or goes beyond the stop-loss level, the order is triggered and the position is closed, helping to prevent further losses. On the other hand, take-profit order is used to lock in profits by automatically selling an asset when it reaches a specified price level. Traders set a take-profit price, and when the market price reaches or exceeds this level, the order is executed, securing the gains from the trade. Take-profit orders help traders capitalize on favorable price movements without the need for constant monitoring. Both stop-loss and take-profit orders are essential components of a trader's risk management strategy. They provide a structured approach to managing trades and help traders adhere to their predetermined risk to reward ratios. In a real-world scenario, these tools help you manage risk and secure profits without needing to constantly monitor the market. They are essential for disciplined trading and risk management. Before we talk about backtesting your strategy, let's overview the entry and exit triggers. Entry trigger and exit trigger are terms used in trading to define the conditions or criteria that prompt a trader to enter or exit a trade. The entry trigger or criteria in trading refer to the specific conditions or signals that prompt a trader to initiate a new trade. These conditions are based on the trader's analysis of the market and can vary widely depending on the trading strategy. Common entry triggers include technical indicators, chart patterns, fundamental analysis, or a combination of factors. The exit trigger or criteria are the conditions that signal a trader to close or exit an existing trade. This is crucial for managing risk and locking in profits. Exit criteria can include reaching a predetermined profit target, the activation of a stop-loss order, a change in market conditions, or the occurrence of a specific technical or fundamental signal indicating a shift in the trade's favor. These triggers help traders to make more objective decisions and avoid emotional trading. It's important to backtest these triggers to ensure they align with your trading strategy and goals. And now, we will talk about how you can backtest your strategy. Backtest your strategy. Backtesting is like testing a trading strategy with historical data to see how well it would have worked in the past. Traders use this method to check if their approach would have made money or not by applying it to previous market conditions. It helps them understand how effective their strategy might be before using it in real-time trading. Let's use a very simple real-world scenario to explain backtesting in trading. Imagine you have a friend who claims that every time their favorite basketball team wins, the stock market goes up the next day. To test this theory, you decide to backtest it using historical data. Here's how you might do it. You gather data on the days the basketball team won over the past year. Your strategy is to buy stocks the day after the team wins. You look at the stock market performance the day after each win to see if it indeed went up. After checking all the instances, you tally up how many times the market went up versus down and calculate your hypothetical profits or losses. If the results show that the market usually went up, then your backtesting suggests that the strategy might be effective. So to backtest your strategy, you need to collect your data, define your strategy, simulate your trades, and analyze the results. So, Lesson 4 armed us with the tools to navigate the trading realm, from choosing timeframes to making smart buying or selling moves, managing risks, and practicing strategies with backtesting. It's like getting behind the wheel with a reliable map and a full tank of confidence. Happy trading!